Hey everyone, welcome back to my channel. I'm Stephen Gage, President of Vision Commercial Development, and today we're diving into a topic that's crucial for any real estate investor, especially if you're just starting out: the most common real estate traps. These are pitfalls that can trip you up and cost you a lot of money if you're not careful. But don't worry, I'm here to guide you through them so that you can avoid these mistakes and set yourself up for success. Let's get into it. Number one is failing to make a plan. First up, failing to make a strong plan is one of the biggest problems I see with new investors. Many new investors jump into real estate without a clear strategy, which can lead to poor decision-making and financial strain. It's crucial to develop a comprehensive plan to follow. Decide if your primary goal is rental income, flipping for profit, or long-term appreciation. Next, assess your risk tolerance to understand how much risk you're comfortable taking on. Set a budget that considers all potential costs and research your financing options thoroughly. Identify target markets and property types that align with your investment goals and create a timeline with short-term and long-term milestones. A well-thought-out plan helps align your purchases with long-term objectives and provides a roadmap for success. Without a plan, you're just throwing money into the wind. The next common thing I see investors skimping on is research and due diligence. Thorough research and due diligence are essential for making informed investment decisions. Neglecting this critical step can lead to costly mistakes. Your due diligence should include legal due diligence, physical due diligence, financial due diligence, and market due diligence. Legal due diligence includes reviewing property titles, leases, contracts, and zoning regulations to ensure compliance and avoid legal disputes. Physical due diligence involves conducting professional inspections to assess the property's condition and to identify potential issues or necessary repairs. Financial due diligence means analyzing the property's financials, including rental income, expenses, and cash flow projections. And then lastly, market due diligence involves researching local real estate trends, supply and demand dynamics, and economic indicators. By taking a comprehensive due diligence approach, it will allow you to make informed decisions, negotiate better deals, and mitigate any risk. Another common trap is underestimating expenses. Many new investors fail to account for all the costs associated with property ownership, leading to financial strain. Commonly overlooked expenses include property taxes, insurance, maintenance and repairs, utilities, especially for vacant properties or common areas, property management fees, vacancy costs, and capital expenditures like roof replacement or HVAC upgrades. To avoid underestimating expenses, create a detailed budget that includes all potential costs. Research the typical expenses associated with property ownership in your area to ensure that your estimates are accurate. Set aside reserves for unexpected expenses to avoid financial strain when surprises arise. Regular maintenance can help prevent costly repairs down the line, so ensure that you budget for ongoing upkeep. It's crucial to create a comprehensive budget that includes all potential expenses to accurately assess a property's profitability. Missing out on these expenses can turn what looks like a great deal into a financial nightmare. Number 4, ignoring the importance of location. Location, location, location. You've probably heard this a million times, but it's true. Your investment property's location significantly impacts its value, its rental demand, and appreciation potential. Key factors to consider include proximity to essential services and amenities, the quality of local schools, neighborhood safety and crime rates, access to public transportation, the local job market, and future development plans for the area. If you're investing into houses or multifamily homes, spend time understanding the neighborhood and its amenities. Check the quality of local schools if your target market includes families. Review crime statistics and talk to locals about neighborhood safety. Ensure the property has good access to public transportation and major highways. Understand the local job market and economic growth to gauge future demand for properties in the area. Investing in a desirable location can lead to higher property values, stronger rental demand, and better long-term returns. Remember, you can change a house, but you can't change its location. For those investing in commercial real estate, location is equally critical, but involves additional considerations. Proximity to business districts, Accessibility for employees and clients, and the overall economic health of the area play significant roles. Look for locations with high foot traffic if you're investing in retail spaces, or near major transportation hubs if you're considering industrial properties. Understanding local zoning laws and future development plans is crucial, as these factors can dramatically impact the viability and profitability of your commercial investments. Choosing a prime location for your commercial property can attract quality tenants, ensure higher occupancy rates, and provide better returns on your investment. While leverage can amplify returns, excessive borrowing can also magnify losses and increase risks. New investors should maintain a healthy debt-to-equity ratio. They should have adequate cash reserves for unexpected expenses or market downturns. They should consider the impact of interest rates on cash flow, and they should avoid relying solely on appreciation for profitability. To avoid over-leveraging, maintain a healthy debt-to-equity ratio and avoid taking on too much debt. Keep adequate cash reserves for unexpected expenses and market downturns. Understand how changing interest rates can affect your cash flow and plan accordingly. Ensure that your investments are profitable even without significant appreciation. Responsible use of leverage can enhance returns while minimizing risks. It's about finding that sweet spot where you can benefit from leverage without putting yourself in a precarious financial position. Many new investors try to do everything themselves in order to save money, but this can lead to costly mistakes. Building a team of professionals can provide valuable expertise and support. This includes a real estate agent with local market knowledge, a property inspector for thorough evaluations, a real estate attorney for legal guidance, an accountant for tax planning and financial advice, and a property manager for efficient operations. Misunderstanding market dynamics is a common problem that I see. Real estate markets are local and can vary significantly even within the same city. Common misconceptions include assuming all markets behave similarly, overlooking seasonal fluctuations in demand, ignoring local economic factors and job market trends, and failing to anticipate changes in supply and demand. I personally am aware of how demand changes throughout the year and consider seasonal fluctuations. I keep an eye on local job market trends and economic growth so that I can understand their impact on the real estate market in order to stay informed on changes in supply and demand that could affect my investments. Understanding the nuances of local markets is crucial for making informed investment decisions. You need to get to know your market inside and out. Lastly, having a lack of patience and long-term vision is a major trap. Real estate investing typically requires a long-term perspective. Common mistakes include expecting quick profits without considering market cycles, panic selling during market downturns, neglecting to reinvest profits for portfolio growth, and failing to adapt strategies as market conditions change. Don't invest into any real estate if you don't understand that real estate investing is a long-term game. You have to be patient. Avoid panic selling in response to short-term market fluctuations. Reinvest your profits to grow your portfolio over time, and be flexible and willing to adjust your strategies as market conditions change. If you found this video helpful, give it a thumbs up. Subscribe to my channel for more real estate insights and hit that notification bell so you never miss an update. And if you're interested in commercial real estate investing and don't want to do it alone, our company, Vision Commercial Development, is always on the lookout for new investors who'd like to participate in groundbreaking projects. If you want to start working with the team today, head over to visioncommercialdevelopment.com and let's chat about new and fun investment opportunities that we could potentially work on together. If you have any questions or thoughts on real estate, please drop them in the comments below. Thanks for watching, and we'll see you next time.